Thank you for joining Global Second Quarter 2019 Investor Call. My name is Travis Briggs, CEO of ROBO Global US. Also on the call today is Jeremy Caprone, Director of ROBO Global Research, and Lisa Chai, a Senior Research Analyst with us. I'd like to take a few minutes to introduce our firm, and then Jeremy and Lisa will cover second quarter review and also an introduction to a recently launched strategy, Healthcare Technology and Innovation. So to begin with, ROBO Global is a research and investment advisory company focused on robotics, AI, and more recently, healthcare technologies. I guess it was about 6 years ago, we recognized the inevitable trend and expansion of automation and robotics. It was clear, really even back then to us, and I'd say even more so today, that automation is a multi-decade secular trend. At the time that we launched the strategy, there really wasn't a way to invest in the theme. So we put together a team of experts and investment professionals and launched the first strategy focused on robotics, automation, and AI, what we call today RAY. Today, there's just under $3 billion in funds tracking our strategies, primarily in ETFs and most notably ROBO, which was the first robotics and automation AI ETF launched, as I said, 6 years ago. The ROBO Index, as we will talk about shortly, is a research-driven selection of best-in-class robotics and AI companies around the world. It includes mostly small and mid-cap companies, and it's an equal-weighted strategy that is rebalanced quarterly. The strategy has significantly outperformed global equities as robotics and automation has started spreading from manufacturing into basically every industry and in multiple applications. As I mentioned earlier, we also just launched a Healthcare Technology and Innovation Fund. That's really the brainchild of the last 5 years of research that we've been doing. We recognized that the healthcare space was on the cusp of significant technology change and transformation. We designed a new index, the HTEC index, using basically a similar roadmap to how we produce ROBO, which will help investors track and invest in what we think will be one of the largest investment opportunities, growth opportunities over the next decade. Moving on, I want to briefly talk about our advisory board. I think one aspect that really separates ROBO from the market is our advisory board, our relationship with the advisory board and how we work with them. As you can see, these are some of the most prominent thought leaders in robotics and automation in the country. There's Daniela Rus, who runs the MIT AI Lab, which is the largest in the U.S. Hundreds of companies have come from that laboratory. We also have Manish Katura. He's the president of SRI Ventures, which is the home place of surgical robots. And lastly, I'll mention Rafael De Andrea, who's the founder of what has become now Amazon Robotics. So in addition to the financial analysts and the financial team that we have, we've put a lot of effort into really understanding the technologies and engaging the people who actually understand and lead this revolution. So thanks again for listening. And now I'd like to turn it over to Jeremy to discuss second quarter.
Thank you, Travis. And before we talk about the second quarter, I wanted to highlight the long-term performance of the ROBO Index, which is illustrated on this chart. ROBO is a research-driven index composed of best-in-class robotics, automation, AI companies from around the world. And you can see here it has significantly outperformed the World Equity Index this year, but also over the past 3 years and 5 years, with annualized returns of more than 17% in the past 3 years and more than 8% for the past 5 years. And particularly in 2016 and 17, when the strategy returned a total 72% over just 2 years. And back then, robotics was essentially firing on all cylinders, from factory automation to surgical robots, warehouse and logistics automation, retail, food, basically all subsectors of the index performed very well. Last year, however, was a different story, and factory automation stocks were hit by a weakening industrial market and the trade war. This year, we've seen a spectacular recovery in the first quarter and further gains in the second quarter, despite a continued deterioration in the economic outlook. And I think there's quite a bit of confusion today with equity markets and bond markets sending conflicting signals. Yes, economic growth is slowing globally, and the current expansion is now the longest on record. But from our perspective, this slowdown has been primarily driven by a downturn in industrial activity, and that was compounded by the trade dispute between the U.S. and China. And we think that growth is likely to pick up later in the year as manufacturing bottoms out and central banks enter a new monetary easing cycle in all key regions. So on that next slide, I'd like to talk about some of the important dynamics that we saw play out in the second quarter. And the first point here is that after 6 consecutive quarters of slowing sales and earnings growth, we believe that the second quarter marked the bottom in this cycle, and earnings for the ROBO Index are set to increase again from Q3. Earnings per share estimates point to 6% growth in 2019 and 15% for next year. And the main reason for this stabilization is what happened in the industrial-related portions of the index. That is basically factory automation, which drives nearly 1/3 of the portfolio. And that was the pain point during much of last year. Particularly in Europe and China, where buyers of automation equipment delayed purchases in the face of rising uncertainty around trade, with the U.S. really compounding the down cycle. And we saw orders for factory robots decline rapidly from the summer of last year. But in the last few months, it's become clear that order rates are now at or very near the bottom, and stocks have started to price that. And this is especially apparent among the Japanese members of the index, which typically have big businesses with Chinese customers. And manufacturing PMIs around the world are at the point where they have typically bottomed in prior industrial cycles. Now, the best performing sectors during the quarter were energy, 3D printing, and logistics, while consumer and security declined. And if you look at the table, you can see the dispersion in terms of returns by subsector and the benefits of diversification, which is a key characteristic of the ROBO Index. The last point I want to make here is that we're now seeing a clear acceleration in M&A activity in robotics, automation, AI. 9 ROBO Index members have been acquired since the inception of the index in 2013, and another 4 were targets of failed takeover attempts. Now, M&A activity, as well as funding of newer companies, continues to accelerate. And the ROBO Index members are themselves increasingly deploying capital towards acquisitions. In the first half, we saw more than 40 M&A deals announced involving 28 of our ROBO Index members. And you will find more details in a recently published report that is available in the research section of our website at roboglobal.com. And with that, I will pass it on to Lisa to discuss a few of the big movers last quarters and some changes that were made to the index.
Great. Thank you, Jeremy. So as Jeremy stated, we had a solid performance this past quarter. On top of the list is Qualcomm as our top performer, up 34%. What drove the performance was that Qualcomm finally settled its long-awaited patent litigation with Apple and surprised everyone with its multi-year agreement where they will supply Apple with 5G modem chipsets. It was a significant milestone for Qualcomm, and the stock reached a 5-year high on the announcement. Now that the overhang of this litigation is gone, investors can focus on Qualcomm's core business and its leading position in 5G modem technology. Qualcomm currently has about 130,000 patents in their portfolio, and we believe there's a long tailwind to the deployment cycle of 5G over the next several years. And also want to highlight that Brooks Automation also posted strong performance during the quarter, up 32%. Brooks has been in the semiconductor capital equipment market for over 2 decades. And in the recent years, they have been actively diversifying by applying their automation expertise in semiconductor process tools, and they've been applying it in sample storage business in the life science category. Brooks' exposure to life sciences is now just over 40% of the business, and it grew 26% last quarter, driving the stock higher. We believe that life sciences will continue to be a driver of growth over the coming quarters for the company. Shares of Brooks also have been one of our best performers year to date as well, up 58%. On the bottom performers list, Biotelemetry, the leader in mobile cardiac monitoring, they reported disappointing results as organic sales growth slowed to high single digits. And that was due to a major system upgrade that took longer than they expected. Management did raise its full year guidance to reflect the acquisition that they recently made. It's a company called Geneva. It's a very innovative cloud-based platform for cardiac data, which should benefit Biotelemetry later this year. And meanwhile, iRobot shares declined 22% during the quarter. As some of you may know, iRobot is a maker of the Roomba robotic vacuum cleaner and other smart solutions for the connected home. iRobot shares give back some of its strong gains from the first quarter performance, as the China tariff situation really hit the company harder than anyone had anticipated. U.S.-China trade negotiation is still somewhat of a fluid situation, and iRobot continues to take actions to move its production outside of China at the moment, but that shift is going to take some time. So the company's earnings power has been temporarily reduced. On the next slide, we had a few rebalances during the quarter. A company called Omnicell was included in the healthcare subsector. Omnicell is a leader in medication management industry with an automated hardware and cloud solutions from the hospital to the home. We believe that Omnicell is poised to grow double digits over the long term as they continue to leverage automation and analytics across all of their systems to better track medication inventory and also streamline pharmacy workflows for patient safety. This is a very underpenetrated market, and we believe the company has very strong growth prospects ahead of them. We also have one bellwether change. Blue Prism was moved to bellwether status in our computing processing and AI subsector, as the company continues to rapidly expand with now over 1,000 global clients using its solutions. Blue Prism is the second largest provider of robotic process automation called RPA, essentially creating a virtual workforce for back office operations. Blue Prism is currently working on the next generation RPA system that incorporates more artificial intelligence, as RPA as a segment evolves into more of an intelligent and interactive digital workforce. We believe that Blue Prism will continue its momentum in growing its revenues by over 75% this year as they continue to invest to support its growth projections. And there were also 2 deletions to the ROBO Index series. Lincoln Electric was excluded from the industrial manufacturing subsector due to the increasing competitive threat presented by robotic laser welding to its core arc welding business. While Lincoln has been building out its automation business in recent years, we felt that the company has been really unable to keep pace in laser welding, which is rapidly gaining share in automated manufacturing systems. So Lincoln was removed. And meanwhile, Yushin Precision Equipment, it's a Japan-based provider for the injection molding industry. Their trailing 3-month composite daily value traded was below our liquidity level for the second consecutive rebalance. So we removed Yushin from the index series. And back to you, Jeremy.
Thank you, Lisa. I just want to spend a minute on this portfolio characteristics slide here, which depicts the index as it currently stands. And I'll make a few points. Number one, diversification. That really is a key word for the ROBO Index. You can see here on the pie charts diversification across technologies and applications from manufacturing to logistics to food and security and healthcare. Also in terms of the core technologies that are covered, the fundamental technologies that make robotics and automated systems possible, sensing, computing, actuation. The index also has diversified exposure to by geographies. We have 14 different countries represented, U.S. and Japan being the largest ones. Diversification across the market cap spectrum. As Travis mentioned, there is a strong tilt towards small and mid caps that account for 2/3 of the portfolio. The second point is differentiation. The reality is that most investors don't own the stocks that are part of the ROBO Index. And you can see on the lower right corner here the overlap stats with broad market indices. And the overlap with the S&P 500 is under 3%. The overlap with the MSCI World Index is less than 2%. So there's a very high active share in the robo strategy. And the last point I want to make is on valuations. This is not a group of high-flying tech stocks with high valuation multiples. You can see the forward PE as of the end of the second quarter was just under 24 times forward. And that compares to a long-term average of 22 times, and the high that was reached in 2017 at more than 27 times PE. So valuations appear reasonable, particularly at this point in the cycle. Next, I want to talk about the recently launched Healthcare Technology and Innovation Index under the symbol HTEC, HTEC for healthcare technology. In a nutshell, we believe that healthcare is the next major sector that's going to be profoundly transformed by robotics, AI, and other digital technologies. And in the last few years, the convergence of robotics, AI, and life sciences has enabled breakthrough advances, some of which are shown on this next slide. If you think about it, we now have more than 5,000 robots around the world's hospitals, assisting with more than 1 million procedures last year. We have AI that can help physicians increase the accuracy of their diagnosis when reading medical imaging and other test results. We have 3D printed implants, we have miniature heart pumps, wearable devices that measure cardiac activity, blood sugar levels, and perhaps most importantly, we now have affordable gene sequencing technology. And that has opened the door to an entirely new medical approach when it comes to detecting diseases at very early stages and to develop custom treatments that are tailored to individual needs. And the first gene therapies have just been approved by the FDA. The number of clinical trials to find a cure for cancer using genomic data has more than doubled in the past 2 years. And this is pulling a lot of demand for all sorts of life science tools and equipment, as well as lab automation equipment. So we think there could not be a more exciting time for doctors, patients, and investors in healthcare technology. So we've designed an investment strategy that seeks to benefit from the technology-driven changes in healthcare. And here on this next slide, you can see some of the major trends that the strategy captures. And first is the shift from analog to digital. Then the shift from a system focused on sick care to one where the emphasis is on early detection and prevention of diseases. And that's based on the increasing availability of data, from test results to wearable sensors, and the use of genomic testing for early detection. Robots and AI will assist physicians and hospitals address the skills shortage that we are currently facing. And lastly, the shift to a more decentralized system where healthcare can be delivered outside of traditional settings with remote monitoring, virtual doctor visits, and telemedicine. And clearly, investors in the private equity world have taken note, and we've seen a dramatic increase in the funding of healthcare startups in recent years. You can see here on the left-hand side, VC funding reaching $27 billion last year, nearly tripling in the past 7 years. And that's healthcare VC funding. And of that 27 billion, about a third went to digital health companies. And on the right-hand side, we zoom in on AI companies. This is AI for healthcare applications, and we saw more than $2 billion in funding for such companies last year, nearly double the amount for 2017. Public equity markets are also telling us that something important is happening, and this chart shows the performance of our HTEC index, which combines the results of our research efforts with the discipline of index investing. So stocks are more or less equal weighted, and the index rebalances every quarter, similar to the ROBO Index. HTEC is composed of best-in-class companies, small and large, that are leading the healthcare technology revolution. And as you can see on the chart, as of the end of June, it had significantly outperformed global equities and healthcare equities. Annualized returns of 33% over the prior 3 years, 24% over the prior 5 years. Now, of course, most of this represents a backtest, and as we all know, past performance is not indicative of future results. So let me touch on the methodology and index construction. It starts with the research process. We research and evaluate companies involved in the 9 following areas that we believe provide strong growth and returns opportunity for investors. And traditional classifications, such as GICS, fail to accurately represent robotics, AI, and the other technologies that are powering this healthcare revolution. So we created a proprietary classification, which serves as our map, and we analyze companies through this lens to measure each company's revenue exposure to these sectors. And so here you can see we cover data analytics, precision medicine, telehealth, and diagnostics, robotics, of course, and genomics, among others. So what we do is we look for companies that derive a significant percentage of revenues from the 9 sectors of the classification, and companies that are in a position of technology leadership and market leadership. And we score them on those factors. And we constantly reassess scores as businesses evolve. That's based on our research activities, the analysis of financial disclosure, management meetings, conferences, etc. And then we screen out companies that fail our ESG policy, which is focused on environmental damage and human rights violations. And finally, we apply a set of quantitative filters, including a financial screen, a minimum market cap of $200 million, and a minimum trading value of $1 million a day. Now, in terms of the rebalancing process, we used a modified equal weight system with weightings that are currently between 75 bips and 1.5%, and we reset every quarter, which means the index generally buys low and sells high. For example, if a stock jumps in value over a short period of time, we'll trim this stock at the quarterly rebalance and bring it back to its initial percentage weight every 3 months. And we think a diversified approach is best because we're still in the very early stages of this healthcare technology revolution, and it's extremely difficult to predict which applications will take off and which will be less successful, and more importantly, when. So spreading the bets across the value chain significantly increases our chances of picking a winner and maintaining a good risk-adjusted returns. Now, the resulting portfolio is shown here, and you can see that diversification across sectors, across countries. There's more than a dozen countries represented, and diversification across market caps. And here again, a tilt towards small and mid caps, which represent nearly 60% of the portfolio. And that is quite different from what you may find in the various healthcare funds in the market. In fact, they overlap with traditional market indices, like the S&P 500. MSCI World is very low, under 4%. So investors, again, with this strategy, generally, investors don't own these stocks. I'd like to show the comparison of the HTEC index with a traditional global healthcare index. I mentioned the high active share. This is what this bar chart on the right-hand side illustrates. In terms of sector allocation, you can see first that HTEC has very limited exposure to the traditional pharmaceutical industry, which we expect to be significantly disrupted in the future, and which typically accounts for over 40% of global healthcare funds. And the second point is a much higher exposure to technology, hardware, and software providers, as well as biotech companies, primarily those involved in genomics and precision medicine. And the third point is that there's nearly 20% exposure to life science tools, which are the companies that are providing the picks and shovels for the gold rush, the technology that is behind research and development efforts across the healthcare industry. And the final point I'll make here is that this index has significantly outperformed global equities in recent years. I mentioned the 30% plus annualized return over the past 3 years. However, it does not trade on extreme valuations. Most of the gains have been driven by earnings rather than multiple expansion. And the index currently trades on a forward PE of 25 times and the median and 5 times sales. I think I will leave it here and pass it back to you, Travis. Thank you.
Jeremy. And let's jump in quickly to some of the questions from investors. We really only have a couple of minutes left, so we'll make it quick. One that popped up on my end was a question that or identifying ROBO. ROBO is an index, but it does have an ETF. It tracks it. That ETF trades under the same ticker, ROBO, on the New York Stock Exchange. We'll go to Catherine's question. It says, robotics, automation, and AI stocks are doing well. Are there any particular segments of the market you're expecting strong returns from in the coming quarters? Jeremy, do you want to take that one?
Sure. Well, look, it's, the future is very hard to predict, as we'll know. And that's why we designed the ROBO Index this way, with diversified exposure to all the promising areas of robotics AI. And if it's very hard to take a strong view on what would be the best performing sector in the future, I can tell you that healthcare really stood out in recent years as one of the key drivers of performance. And we've seen robotics, AI, and other digital technologies spread into healthcare and make a significant difference. And hence the launch of the new HTEC strategy recently. The other sector I would call out is logistics and warehouse automation, where we've seen the boom in e-commerce drive a significant acceleration in terms of the adoption of automation in warehouses and across supply chains. This trend appears very firmly set, and I don't see any reason why it will weaken in the near future.
Great, thanks. And next question asks, what is ROBO's view of China, and what is the exposure of ROBO? Lisa?
Yeah, I could answer that. We do have exposure to China through our industrial and factory automation companies. It is around 20% at the moment. Early this year, we began adding China A shares into the index, and that allocation should increase over time with the inclusion factor in mind.
Perfect. And then lastly, Aaron asks, how does ROBO differ from other robotics indices? I would say in many different ways, but Jeremy, do you want to quickly elaborate on that?
Sure. I think the key point here really is research. The ROBO Index is research-driven, It starts with the analysis of companies involved in all areas of our classification. We have a database of more than 1,000 companies that touch on our theme. And as you heard today, we're a group of not only investment professionals but also leading industry experts that help us steer our research efforts in the right direction. So this research effort, I think, is a key differentiator. Now, in terms of the portfolio composition, I will highlight the diversification relative to other strategies in the market, where you will typically see much more emphasis on factory automation. That is probably the more cyclical area of robotics today. The ROBO Index is exposed to many other end markets, including logistics, food and agriculture, healthcare, of course.
That's great. Yes, I'll also just highlight in terms of differentiation, the ROBO Index is approximately 60% small to mid cap, which you just don't get in most HTEC. So that concludes our newsletter and our website, roboglobal.com. Thank you all very much for your time.